Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back. In this video, we continue the discussion by breaking down the financial signals, due diligence questions, and long-term risks investors should consider when evaluating gig platforms in 2026. No reimbursement for work expenses, gas, mileage, phone data, tools, or vehicle wear pushed onto workers in places that require repayment. Weak safety protections, poor incident support, pressure to take risky jobs, or lack of required training. None of these alone proves a violation. Together, they often signal a company squeezing labor rules to keep prices low. How legal trouble turns into business damage, not just fines. Fines make headlines, but the bigger costs often sit behind the curtain. Legal trouble can trigger back pay for past work, plus penalties and interest. It can also lead to forced changes like reclassification, which brings payroll taxes, unemployment insurance, workers' comp, and benefit costs. Then come the second-order hits. Legal fees and settlements that drag on for years. Government monitoring that limits flexibility and adds reporting costs. Permit and market access risk, when cities or local agencies tighten rules or restrict operations. Worker churn and strikes, which raise customer wait times and refund rates. Brand damage that makes hiring workers and signing partners harder. Investors also need to price in regulatory overhang. When a business has open investigations, active class actions, or a long track record of disputes, lenders and partners often demand better terms. The cost of capital rises, and growth slows, even if revenue still looks strong on paper. A simple checklist to spot labor law risk before you invest. You don't need inside access to spot labor compliance problems. Many clues are public, you just have to look in more than one place. Start with the company's own words. Earnings calls, investor decks, and risk disclosures often hint at exposure, even when phrased carefully. Next, check court dockets and regulator press releases for investigations, settlements, or repeat complaints. Then look at worker forums and app reviews, not as perfect evidence, but as early smoke signals. If hundreds of workers describe the same pay problem, it's worth attention. Also watch for frequent changes to pay models. A platform that keeps rewriting how workers earn, without clear explanations, may be trying to manage legal pressure or public backlash. Verify with multiple sources before drawing conclusions. Due diligence questions that reveal misclassification and wage risk. Use these questions to pressure test what you're reading. What % of the workforce is classified as contractors, and how does the company justify it? How much control does the platform have over pricing, job acceptance, and routes? Are there penalties for rejecting work, low acceptance rates, or going offline? Are earnings guaranteed in any way, and is the formula easy to understand? After likely expenses, fuel, mileage, phone data, do workers still clear local minimum wage rules? Does the platform reimburse required expenses in places where the law expects it? Can workers download a full earnings history with time, distance, fees, and tips clearly separated? How often does the platform deactivate workers, and is there a real appeal process? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.